if we have a joint application, which credit score do we use? Do we blend them? Do we average them? Do we take the highest? Do we take the lowest? And, it's a good question. It's an important question because there are so many things that your credit score impacts when you're in a loan application. For example, do you have the minimum score for the program requirements? Every program has a certain, floor below which you're not eligible for that program. So do you meet the minimum threshold? Whether you get approved or not. Even if you meet the minimum threshold doesn't mean you're necessarily going to get it approved. These electronic underwriting engines that both Fannie and Freddie and FHA and everybody uses to evaluate credit, what human underwriters used to do, uses a process called layering of risk. And they will look at different layers of risk, and one of those layers is the credit worthiness of the individual. Okay, other layers are how much down payment, what's your job history, how stable is that? There's all kinds of layers there, but one of those layers of risk is your credit score. And so you may meet the minimum conditions of a program, but still not get an approval because your score is low and the other layers of risk don't compensate for that. So it can influence whether you get approved or not, even if you meet the minimum threshold. Of course, it impacts your interest rate and fees. Typically, lower credit scores mean higher cost, either in the form of higher rate or higher fees, and so that can be impacted. Can also impact mortgage insurance cost. Your mortgage insurance factors are keenly tied to your credit scores because mortgage insurance companies take on that first layer of risk with regard to your loan. If you default, they're the ones who are going to take the hit first, and so of course they're very concerned about your credit worthiness. And so that will impact your mortgage insurance costs. So you see many different implications of the credit score. And so the answer is really pretty simple. The answer is really pretty simple. You have three different bureaus, Equifax, TransUnion, and Experian, and they all give each borrower a credit score. So you have two borrowers in this example, 3 credit scores each, that's 6 credit scores. And the way that all of these programs look at that is they're going to look at each borrower separately first, and they're going to say, okay, what's the middle score that you have? You have 3 scores. What's your middle score? Not an average, but the middle number. And they're going to take that number. Now, if you just have 2 scores, most of these electronic underwriting engines allow for 2. Most don't allow 1. But if you have at least 2 scores and maybe a third score is not reporting because that bureau does not have enough data on you, they'll take the bottom of the 2, but most of the time you have 3, and they're going to take that middle score. And then they're going to take the other borrower's middle score. And they're going to compare those to one another, and then they're going to take the lower of those 2. They're not going to average those. They're going to take the lower of those 2. So that's the way they determine which score you're going to use. Now, if it were me, I would now launch into some strategies about how to deal with different scores. But my social media guru son has told me I can't do that. So, goodbye for now.